What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this evening. So what we're going to be covering in this update is a little bit of some good news that we're seeing with the market and some of the bad. Now, the good news actually relates to AMC, the company specifically, which is actually pretty good to see. We're going to be going over the technicals on the AMC chart. Obviously, we're going to take a look at Ortex and the Max Payne. We're going to be going over some box office numbers as well, because those are really heading up. And then some very interesting things happening in the streaming industry, specifically with Netflix, how they are laying off employees and losing subscribers. But if you have any money invested in the United States stock market right now, there are some things that you have to understand, and the implications of these things are really going to set you guys apart from a novice investor to somebody who really understands not only how stocks are going to move, but the overall macroeconomic reasons as to why we are seeing the moves that we are seeing. I want you guys to understand this so that we become educated retail investors. Now, at the end of the video, we're going to be going over a little bit of a light at the end of the tunnel, because where we're sitting in terms of inflation, rate hikes, and the potential for a pretty big recession coming up, there is something that I do see the Fed that they might do towards the end of either this year or next year that we've talked about a few times, and now we're starting to see it circulated in the media as well, and I want to go over that with you as well. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So on Friday, AMC closed the day at $13.53, down 2 cents, 0.15%. Pretty flat day, especially after we saw that pretty significant pop in the morning. But let's go over and take a quick look at the technicals on the longer time frames just to get an indication of what we're looking at. This is looking pretty good right now on AMC. What we've seen is that 1348 crossover on the 4-hour time frame, but we are seeing a little bit of confusion here on the RSI, MACD, and shaft trend cycle. Remember, what we talk about a lot is a break up, consolidation, or a slow move up above this 200 exponential moving average. Remember, we have these resistance levels up in these levels down here. We've got about 1475. We've got this previous run level in the $16 level here, 1660 about. So if we can break out of these ranges right here, we could be in a pretty good spot. Now, if you guys do want access to this chart and all of the other awesome aspects of 1348, the private live streams, the whole built-out learning curriculum, the options data, the options alerts, make sure you check out that link down below and join us over there. But let's see what SPY is looking at right now. So again, what we've seen in the past is that AMC is typically going to follow the overall market. Now, when you look at the market on kind of a longer time frame, it's in what I would like to call a little bit of no man's land. So we've seen this cross down on the 4-hour time frame, and we saw what we like to call a rim over here. So it falls down, we see it come back up, use this 13 EMA as a dynamic level of, in this case, resistance, comes back down, but then breaks back above, and you're seeing the price trapped in between the 13 and the 48 EMA. What this would signify to me is, well, we could easily see a break up or a breakdown. The RSI is pretty flat and pretty neutral right around 50 here. We see the MACD not really showing any momentum, and the shaft trend showing something very similar too. So we're kind of in a spot here with the overall market and the technicals that we're seeing that it could really go either way. If we start to see a break up, again, we could easily see AMC get over this 200 EMA here and really start to have some bullish momentum. And when we come over and take a look at the short interest data right here, 18% live estimated short interest as a percentage of the free float. Again, we're seeing some nonsense with Ortex. I'd like to see what happens with this going into next week. We're still seeing really high cost to borrow, 41.45% max, average 15.71%. Shares on loans messing around a little bit over here. We were at 190 million. Now we're at 153 million. So again, wait until a couple of days in next week. Then we can kind of get an indication of what we're looking at there. Now, when we take a look at Max Payne here really quickly, again, 13 is going to be the Max Payne going into next week. Can it change? Absolutely. And in my opinion, Max Payne is definitely not what you want to be looking at to guide your investment decisions going into any single week, but it is something to keep a lookout for. Now, let's get into some of the good news with AMC here that we're seeing in the overall movie theater industry. So we just finished Q2, and right now, in terms of the domestic yearly box office, we're about $3.7 billion. Well, last year we did about $4.5 billion in 2021, a significant increase over the $2.1 billion in 2020, the year of the pandemic. So we are seeing a significant rebound in the movie theater industry, which is really awesome to see. Now, by the end of the year, with some awesome movies coming out as well, we could see these numbers much higher than what we are currently seeing. Right now, we're currently set up in a pretty significant way. I'd say if we were to track, we could end up seeing about 7, 8, maybe 9 billion in revenue in the total or in box office numbers for the total year of 2022, but it can always be higher. But looking at this right here and then comparing this to what the media loves to say as movie theaters' biggest competition, when we come over here and look at Netflix, is Netflix going downhill? I'll just answer that right now. Absolutely. For the second month in a row, Netflix has cut employees to manage company costs. Netflix will be laying off 300 workers from its staff, the Wall Street Journal reports, to be about 3% of the streaming service's workforce. Why the cuts? The move was made to cut costs after the company reportedly lost 200,000 subscribers in the first quarter of the year. Netflix had expected to gain 2.7 million users during that time. So Netflix significantly missing market expectations and going downhill. AMC, movie theater industry, complete opposite right now. So in terms of the actual fundamentals in the industry, yes, it is rebounding. We still have a long way to go, but we are looking good right now. Now, we have to talk about what's going on, and this is kind of where the bad news part comes in. There is a light at the end of the tunnel. There is a possibility for some very interesting things to happen with the Fed and a couple of these other regulatory bodies as well. But I want to bring your attention over to a few things. First, short interest as a percentage of market cap on the S&P 500 median has reached a 2-year high at about 1.7%. This isn't short interest as a percentage of the free flow, it's short interest as a percentage of market cap. So it's a little different metric here, but again, we've seen a lot of data points like this in the past where short interest is very high. So there's a lot of money betting against US equities right now. Why is that? Well, when we come over to this article here, this is probably the most important thing that we need to talk about. Now, we made a video about this a few days ago where the Atlanta Fed came out with their expectation for Q2 GDP at -1%. This was on June 30th. Now, they've recently come out again and basically said it's going to be even lower. So the continued erosion in economic data has prompted the Atlanta Fed to slash its forecast for Q2 GDP growth to -2.1%, meaning the U.S. is now technically in a recession after Q1's confirmed 1.6% contraction, meaning -1.6% yesterday. The GDP Now model estimate for real GDP has collapsed in recent days. Growth in the second quarter of 2022 has been cut to a contractionary 2.1%, down from 1% negative on June 30th and down from 0% on June 15th. So you can see how fast these estimates are moving down. Now, what does this mean for us? Well, there's a couple of things. Remember, the overall kind of macroeconomic environment right now, we have high inflation, and in terms of monetary policy, we are seeing the Fed start to increase interest rates in order to try to slow down inflation. They're also trying to sell off their assets that they have right now, the balance sheet runoff, and nothing is really seemingly working to get inflation under control. Now, when the Fed raises interest rates, it does a couple of things in the overall economy. It basically inhibits growth. Now, with what we're seeing here with the GDP numbers coming down, heading into a recession, the Fed still wanting to increase interest rates and inflation not really going anywhere, they have to make a decision. Now, again, we do have to talk about the business cycle here as well in terms of GDP right here. So we're looking at a peak, recession, depression, trough, recovery, and expansion. That is essentially what the business cycle is. So all of these moves that we are seeing are cyclical. The market cannot continue to go up forever. We do go into recessionary periods, and then we come back up. The real question is how low is this drop going to be? Is this trough going to be all the way down here? Is it going to look something like this, where it comes not necessarily below this line and comes back up? Well, we're still waiting to see. But here is where the light at the end of the tunnel comes in. When we look at what we have just said in terms of inflation is still high, the Fed is raising interest rates, And what they're essentially doing is not letting that growth come back out in the overall market. We've talked about this a few times, but we're now seeing some of these reports coming out on CNBC. There's a very high chance that the Fed ends up cutting rates towards the end of next year. Originally, this estimate was actually I believe in 2024. So they're trying to pull things back now. The comments come amid growing concerns that both the U.S. and Eurozone economies could be facing a recession. The Atlanta Fed's GDP Now tracker now points to a 1% contraction for the year. Now, this came out earlier than that negative 2.1%. So now, even after that new data came out, we could be seeing potentially rate cuts even sooner. So we have these different metrics going on in the market right now that are honestly very confusing and almost opposite to what should be going on. So the powers that be right now, whether it be the Fed or whether it's going to be the ECB or whether it's any one of these other regulatory bodies, they have to make a very important decision here. Do they care about GDP or do they really care more about getting inflation under control? Now, the Fed has come out and said that one of their main mandates is price stability. So that's going to have to do with inflation. Now, if that's going to be the case, we probably won't see rate cuts. But at the end of the day, if we continue to see declining GDP, that is a very significant problem. And that is not going to really encourage anybody to put money back into the United States stock market right now. So these are things that you guys have to know if you have money invested in the market right now. You can't just go in throwing willy-nilly money at stocks all the time. There are very, very specific things that you need to understand about the overall macroeconomic environment. We have high inflation, declining GDP. We have a Fed and a Fed chair that nobody really thinks is capable of getting these things under control. So we are in for a very, very volatile, I would say, next year and a half or 2 years with decisions on what the Fed is actually going to do. So we're going to keep updating you guys as these things continue to come out, but that is going to wrap up this update. So if you guys enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great weekend, and I will see you guys in the next one.